When you hear the word cost, your mind probably jumps straight to the price tag on something, right? But in the world of business and economics, oh, that's just the tip of the iceberg. So today, let's go beneath the surface. We're going to uncover the hidden language of costs, the stuff that really drives every single decision a company makes. All right, let's start with something we can all picture. What does it really cost to open a new cafe? I mean, you'd probably list things like rent for the space, coffee beans, maybe the espresso machine, and of course, paying your baristas. And hey, you're not wrong, but that's only half the story. The most important costs are actually the ones you can't see. Okay, so this is where it all clicks into place. You've got accountants on one side and economists on the other, and they see costs in two totally different ways. An accountant is looking at accounting costs. That's the cold, hard cash leaving your bank account, the explicit payments, the bills. But an economist, they're playing a different game. They look at economic costs, which is all of that explicit stuff plus what are called implicit costs, the value of what you had to give up to make it happen. And that little difference, it changes everything. That whole idea of what you give up, well, it has a name, and honestly, it's one of the most powerful and fundamental concepts in all of economics. It's all about the price you pay for the path you didn't choose. And here it is, opportunity cost. Now, this isn't about all the zillion things you could have done. No, it's laser focused on the value of the single best alternative you said no to. So back to our cafe owner. What if their next best option was taking a corporate job that paid, say, $100,000 a year? Well, that foregone salary is a very real, even if invisible, cost of opening that cafe. And this isn't just some abstract theory, right? This hits home for a lot of us. I mean, think about it. The true full cost of going to college isn't just what you pay for tuition and textbooks. The biggest opportunity cost, by far, is the salary you could have been earning during those 4 years you were in class. All of a sudden, that degree starts to look a whole lot more expensive, doesn't it? All right, so once you get your head wrapped around opportunity cost, a whole new toolkit opens up. See, businesses use a whole bunch of different cost concepts to answer very specific questions about how to run their operations day in and day out. So the most basic split is between fixed and variable costs. Think of fixed costs like your rent or your insurance payment. You have to pay them no matter what, even if you shut down and produce absolutely nothing for a month. On the other hand, you have variable costs. These go up and down with your production. Things like raw materials or the electricity to run the machines. The more you make, the more you spend. Simple as that. Now, this next one is huge. It's all about separating the costs that matter for the future from the costs that are trapped in the past. Incremental costs are the new, additional costs you take on when you make a new decision, like buying a new piece of equipment. Those are super relevant. But sunk costs, that's money down the drain. It's already been spent, and you're never getting it back. Think of a marketing campaign that already ran. The smartest business leaders know that sunk costs are completely irrelevant to what you should do next. You can't let money you've already lost cloud your judgment. Okay, but here's a fascinating twist. How we label all these costs, well, it all depends on our time horizon. What's a fixed cost today might be totally variable tomorrow. You see, in economics, the short run isn't a specific number of days or weeks. It's any period of time where at least one of your inputs is stuck. It's fixed. For most businesses, this is their physical plant, the factory, the store, the cafe. You can hire more baristas tomorrow, sure, but you can't just magically double the size of your building overnight. The long run, on the other hand, that's the planning horizon where anything goes. You can build a new factory, move to a bigger office. Every single thing is variable. So to figure out the sweet spot for production in the short run, we've got a few key tools. We look at the average costs to see what each unit is costing us. But the real secret weapon, the one that drives all the best decisions, is marginal cost. That's the exact, precise cost of producing just one more widget or one more cup of coffee. Okay, let's look at the numbers and see how this actually plays out. Check out the total fixed cost column, the TFC. It's $1,000, whether we make 0 units or 11. That's our rent. It doesn't change. But now, jump all the way over to the right to marginal cost, MC. See what's happening? To produce those first couple of units, it only costs an extra $40. We're getting efficient. But then look, by the time we want to squeeze out that 11th unit, it suddenly costs $110. Our factory is getting crowded, things are getting inefficient. That changing number is the key to everything. So, did you catch that pattern in the numbers? It's not random. The marginal cost and eventually the average costs, they go down, they hit a bottom, and then they start to climb back up. This creates that famous U-shaped cost curve you always hear about. At first, you're getting more efficient, so each new unit is cheaper to make. But eventually, you hit a point of diminishing returns. Think of it this way. As long as the cost of making one more thing is below the average cost, it's pulling that average down. But the second that marginal cost creeps above the average, it starts yanking the average back up with it.
And all of this leads us to the ultimate long-run question, the one every CEO has to answer. What is the perfect size for our company? How big should we get? This is where all these different cost ideas come together to shape the grand strategy.
So, in the long run, think of a growing company as going on a three-stage journey. First, it hits economies of scale. As it gets bigger, the average cost for each item it produces actually goes down. Then, it might hit a sweet spot, a period of constant returns to scale, where it's at its most efficient. But if it just keeps growing and growing, it can run into diseconomies of scale, where getting bigger actually makes it less efficient, and its costs start to go back up.
So what's the magic here? Why does getting bigger make things cheaper at first? Well, it's all about specialization and pure buying power. Suddenly, you can afford super specialized, efficient machines. You can hire experts to just handle finance or just handle sales. You can buy your raw materials in massive bulk and get huge discounts. Even banks will give you better loan rates. It's a virtuous cycle.
But there's always a catch, isn't there? A company can just get too big, too complex to manage well. Communication starts to break down between departments. Layers and layers of bureaucracy slow every decision down to a crawl. The company basically starts tripping over its own feet. And all that inefficiency, all that complexity, it shows up right on the balance sheet as rising costs. Bigger is definitely not always better. So, what's the big takeaway from all of this? It boils down to a really simple but powerful idea. Cost isn't just one number, it's a whole language. And whether you're deciding to launch a new product line or just deciding whether to go back to school, knowing which type of cost to look at, that's the secret to making a better, smarter, and ultimately more successful decision. So I'll leave you with this question to chew on. The next time you're facing a major choice, in your business or just in your life, don't just look at the price tag. Step back and ask yourself, what are the hidden costs? What am I giving up? What is the true economic cost of this decision? Because answering that, well, that could change everything.